The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I hope you're all having a great day today. I currently have 1:28 on my time. I just want to do a really quick sound check. So if you can hear me, please click the raise hand icon just so I can ensure that everybody can hear me speaking. Perfect. Thank you so much, everyone, and we will get started in just a few minutes. Hello, everyone. My name is Sarah Clark, and I'm the program coordinator with CIPH. Welcome to today's Economic and Financial Market Outlook, a complimentary webinar. I'm pleased to note that we have 153 sites registered across Canada for today's session. Before I introduce our webinar presenter, please note that you will have the opportunity to ask questions at the end of today's session. You can do this by typing your question directly into the question box you see in the webinar control window on the right-hand side of your screen. Please save your questions for the Q&A portion at the end of this session. Also note that a copy of today's presentation will be made available to all attendees following the webinar, and you will have the opportunity to submit questions after the session has ended. Today's webinar presenter is Krista Kerr. Krista is CEO of Kerr Financial Group, a leading Canadian wealth management firm providing institutions, business owners, and high net worth families with integrated financial planning, investment management, accounting, tax, estate settlement, and family governance strategies to help them achieve their financial aspirations. Krista is responsible for overall management and leadership of Kerr Financial and is an active member of the firm's investment committee. She also leads the firm's multifamily office division, providing integrated services to support ultra-high net worth families with multi-generational wealth stewardship. Krista is a thought leader in the Canadian personal finance industry and has appeared frequently on television, radio, and in newspapers addressing various planning and investment topics. Krista is also active in community affairs as a board member of the National Ballet of Canada and National Ballet of Canada Endowment Foundation, as well as being chair of the company's Audit and Finance Committee and the Joint Investment Committee. Krista is also a board member of the Festival des Arts de Saint-Sever and the chair of its Audit and Finance Committee. Ladies and gentlemen, please welcome Krista Kerr.
Thanks very much for that introduction, Sarah. It's a little bit of a mouthful there. First of all, I'd like to say welcome to everybody. It's nice to know there are so many people registered for this session and interested in this topic. Before we start, I'd just like to say that I hope everybody is well and healthy, whether you're at home working productively, I hope, or whether you're in the throes of reopening your business, which is important to all of us. I hope you're well and things are working well for you and your families. Ralph had asked whether we could do a little bit of a session for you today to talk about what's happening in the economy and the investment markets and to give you some takeaways, both as business owners and operators and as investors. So that's what we're going to aim to do today. In terms of, as Sarah mentioned, we have a lot of services that we provide, but one of the things we do is help people oversee their portfolios. As part of our investment committee, we really draw on a lot of sources to help guide our own thinking. We don't do a lot of our own stock trading here. We're really doing the overall policy statement and investment plan for our clients, and then looking at what managers fill in the best pieces of people's portfolios. But we use capital economics, which is a good economic source, as well as some other economic sources. We get data from analysts in US large banks and Canadian banks, and also many managers. And really, we try to synthesize all of that information to help guide our own thinking and our recommendations to our clients, and hopefully that's what we can bring to you today. The general outline of what we're going to talk about is just to start with a very brief overview of where we've been so far this year, this very sort of tumultuous movement in the market that we've seen. I expect that many of you have already gone through this kind of a discussion with your own advisors, or have certainly kept up on it through financial news that you access yourself. So we're not going to spend a lot of time on history, but we will talk a little bit about that. Then we're going to think about what are the sort of economic impacts of what we're going through. What does the near-term outlook look like in our view, and what shape will the recovery take? And then what are sort of the implications of that and the things that we should look out for, both for us as investors and business managers. So that's kind of what we're going to go through. If we start going through the slides here, you already heard plenty about me, so I'll skip that one. So the next slide really starts out looking at an overview of where we've been. As I said, we won't spend a lot of time here, but I think it really has been quite a remarkable start to the year. If you think back, we all came off a sort of a difficult fourth quarter in 2018 where things, markets had a struggle. But as we started 2019, the consensus really was that it was going to be a pretty constructive, positive year. COVID-19, or the virus, there was some knowledge that there was something out there in China, but there was really a feeling that that was localized, and the discussion amongst analysts was a lot more around what would a slowdown in China's economy or disruption of imports and exports from China do to Western economies. It wasn't so much a realization of how broad this was going to be. So people really felt at the beginning of the year that we were going to see moderate growth in GDP in 2019 and decent earnings from companies, and that would result in sort of mid-single-digit returns in the market. And really, that's what we saw at the beginning of the year, from January to February 19th, which ended up being the peak in the market so far this year. The Canadian market was up about 4%, US market up about 5% in US dollars. So everything started very positively. All of a sudden, February 19th came along, and you can sort of see this in the slides at the bottom, which we just put for reference. You can see how everything looked like a nice slow positive slope up for the beginning of the year. And then from February 19th to March 23rd, we really had a very serious decline in market performance. And really that was, I think, a realization with things that were happening in Europe and increasingly in the US, that this was a global issue. The COVID-19 was going to be a global issue that we had to deal with, and that the reaction to contain this virus from a health point of view was going to mean a serious decrease in global activity and economic activity, and therefore a big impact on earnings. So there was a real recognition that we were going to see a much slower and negative impact on our domestic product and our earnings. And then we also had a couple of things exacerbate that. In early March, as I'm sure you're all aware, we also had a price war in oil markets between Saudi Arabia and Russia, who couldn't come to an agreement over their supply contracts. So that really hurt energy markets, which hurt Canada because we have such a big portion of our market in energy. So all of those things together created a perfect storm in a way to drop markets quite drastically between February 19th and March 23rd. You can see from the notes here, the US market was down 34% over that time, and Canada, with a heavier energy weighting, was down 37%. What was also remarkable about that decline, not only how fast it happened in both places, is how it was very broad. So really everything came down. The only things that were safe havens were really the US dollar, which had gone up a little bit, and government bonds, which were slightly positive. But even on the bond side, very good quality bonds, such as government-backed bonds or very short-term corporate issues, also came down in price, as did really the stock market across various sectors. And I think really things were exacerbated over that period. So part of it was a recognition that everything was going to slow down, and that was a true fact that we had to deal with. But it was exacerbated a little bit by a few things. One was that hedge funds had a lot of leverage on their books and had to act to deleverage their portfolios, which created more selling impetus. And then I think when you look back, there's also more inexperienced investors in the market now. So institutional investors acted fairly rationally, staying the course with their portfolios, but individual, less experienced investors sold anything for liquidity at any time, and a lot of them were in ETFs, which caused broad selling across various sectors. So really a very deep, tough impact on the market over that period. Then we started seeing a lot of stimulus being introduced. So March 23rd was a little bit of a turning point, and a lot of that was the introduction of pretty healthy both fiscal and monetary stimulus. So on the bond side, which had had a very tough time in March with people not finding buyers for these good quality bonds, the Federal Reserve in the US came out saying that they'd be willing to step in and buy anything from anybody to prop up markets. So there was a lot of liquidity put into the system. There was also a lot of fiscal stimulus introduced in terms of governments providing these announcements of stimulus payments to individuals that would help them, or support for small businesses. So all of that allowed things to turn around, and I think it's interesting to see how sort of quickly, just as the downturn was very quick, we also saw quite a recovery. So from March 23rd really to the end of April, the US market was up 32%, Canadian market up 32.5% from their lows. So at Monday's date, when we updated this slide, the US market is down just about 8.7% year to date in US dollars, and the S&P down 12.8% year to date. So it seems like things maybe aren't so bad. The question then is that true? Have we come through the worst of it, and what will the shape of the recovery be like? And that's what we'll talk about next. But I think if you think about it, some of the remarkable notes are that markets really sped through those changes. There was an awful lot of volatility. The VIX index, VIX, which measures volatility, was as high as 84 in March. So there was really a lot of swing up and down in the markets on a regular basis. Even now we find ourselves with a VIX around 35 to 40, which is still pretty high. And you can see that even this week, you had markets up a lot on Monday on optimism and good news, then down quite a bit at the beginning of the day yesterday, and finishing up at the end of the day. So a lot of volatility and a faster pace. And then also, since then, there has been a little pause. So from April 30th to now, May has been what they talk about as range bound, meaning things are moving fairly sideways. And I think that's natural, that markets take a little bit of a pause. So the perceived optimism that we talk about, that we've seen earlier this week, there was really quite a big increase in the US market on Monday. That's coming from a number of sources. So on the health front, there's two items not grouped together on this slide, but there are some improved virus statistics. So you're seeing some lower incidence of new viruses, or illnesses rather, and some improvement in those statistics. You're hearing some possible developments about therapies. The llama therapy was talked about on the news this morning, which is kind of interesting. And there have been some discussions about the potential for a vaccine that could be available as soon as the early months of 2021. I think that remains to be seen, but that has given markets a little bit of hope. There's been some steps toward phased reopening of the economy. And so that's been in some countries around the world, including some that were very hard hit, like Italy and France and Spain. So we're seeing those countries open on a staged basis, and also through the US. There have been some states that have jumped in, and really all US states are now in some process of reopening, and that's starting to happen in Canada as well. So that was giving people a little bit of optimism. The continued support from governments and central banks around the world in terms of levels of fiscal and monetary stimulus continues to be a positive that's really supporting the markets. And there is a belief out there, you'll see we talk about it later on, that both job losses and the recession will be short-lived. A study that was done in April said that 80% of the people who had recently put in jobless claims, or people that had recently lost their jobs, felt that job loss would just be temporary. Now, we have to talk about what we think that the shape of this recovery will be and what that will look like, but there are some people that are feeling that way. There was also some positive reports earlier this week that China, who's now reopening, has seen a real increase in their year-on-year industrial production numbers. So production was up 3.9%. And that doesn't speak to whether demand is keeping pace for that, but the idea that there was some increased production from China was seen to be a positive. So all those things are positive. Yesterday there was a bit of pause on will these health developments continue? And also having Steve Mnuchin, Treasury Secretary, and Jerome Powell, head of the U.S. Federal Reserve, both talking about the fact that it will take time to get through this recovery. So some of their tones, while they took different approaches, Mnuchin said it's going to be a hard road and there's going to be pain, so we have to reopen quickly. Whereas Powell said it's going to be a hard road, so we maybe need to have some more government support and stimulus. So you can see a little bit of political leanings from both of them, but both of them acknowledge that the recovery could take a bit longer, and I think that's what put things on pause a bit yesterday. So some of this is the backdrop of what's been happening. We then want to think about what does that mean for the economy, and some of these are very obvious impacts that I think we're feeling. One is that all of this shuttering of the economy, people staying home, activity not happening, logically impacts GDP, gross domestic product. So the Congressional Budget Office came out earlier this week saying that US GDP will contract or go down by 11% in the second quarter. So that is a known decline. There's also feeling that there will be some pressure. It won't be a bounce back necessarily in the second half of the year, but impact on economic activity is the starting point. That leads us to an impact on corporate earnings as well. So corporate earnings are expected to decline sharply. RBC recently came out with a study showing that they expect a 40% drop in earnings in the second quarter and continued pressure on some of those things in the second half of the year. The consensus reports on earnings show that S&P 500 earnings are projected to drop from $163 per share, which they were in 2019, to $135 per share in 2020. RBC actually says they feel more comfortable with a range of 125 to 135 for the target for this year. So they think 135 might be a little bit optimistic. And then seeing some recovery of that to $153 per share by the end of next year, by 2021. So not quite back to 2019 levels for a little bit of time, possibly until 2022. It's complicated to assess this right now because a lot of companies have stopped providing earnings guidance. So about 40 companies have said they're not going to provide projections to the analysts of what their earnings will be because there are too many unknowns. So I think we're working on the best information we have, but I think also the impact of a slow pace of phased reopening and the risk of some potential for a second wave haven't really been factored into these numbers yet either. So that's a real impact of this slowdown. Unemployment obviously is something people have heard about. You're seeing really huge increases in the number of jobless claims, both in the US and Canada. In the US, they're thinking that unemployment could reach 15%, which is a huge increase from the low levels that it was at before. On the other side of that, Goldman Sachs is looking at weekly jobless claims, and they're showing that the weekly numbers are coming out at a little bit lower pace in the past few weeks. So possibly that the worst of the unemployment may have already been felt. And this is where I referenced before an April employment report that said that while people are making claims for unemployment, 80% of them think they're only temporarily furloughed, which really helps consumer confidence and hopefully will help the recovery if we can see that be the case. So I think some of that remains to be seen. The other thing that I think is a big potential for an impact that we'll see out of this period is really the level of debt that we're going to build in both countries, or in all countries, I guess, around the world. So as we mentioned before, government stimulus and central bank stimulus is really helping continue to keep markets afloat, which is important. But that also means that government debt is really growing. So this chart shows an interesting impact in that they're saying here that US federal debt may reach 100% of GDP by the end of this year. You can see that slide there, and that's almost as high as post-World War II levels that were about 108% of GDP. So the stimulus is very important. It's keeping the market going, and we need it. We can't not have it, I think, in terms of keeping things going. But on the other hand, it's creating a lot of debt that we're going to have to deal with for time to come. And the question really out of that is, how are we going to pay for that debt that's there? And I think there could be some implications down the road. Nothing's been announced, of course, as yet, but we could see higher taxes in the future to help governments pay for the greater amount of debt that they have. And while there's no real threat of inflation now, Canada came out this morning saying that inflation was actually zero at the moment, and that makes sense given this reduction in economic activity. But if we have a lot of debt and we have to keep printing money to pay for things, you could see an eventual return to inflation in a longer term period. So those are some of the factors that might impact the longer term and the shorter term recovery here, and that we have to keep in mind. So the next question is sort of, what do we think the near term outlook looks like? Was that period of February 19th to March 23rd really the worst that we're going to see? Are we through the worst of it? Have we witnessed the bottom? Or are we going to see some continued pain? And how long will that be? I think that's what everybody's trying to understand. Having synthesized all of the information that we look at as an investment committee and as a firm, we do think that perhaps this big rebound that happened since March 23rd, this big recovery and the feeling that we can all breathe easy and it's all over, might be too optimistic in the short term. So we don't necessarily think we're going to go way lower than March 23rd and get into deeper pain unless we see some real change in the virus and second waves and other things that we don't anticipate or don't know about at this stage, rather. But on the other hand, we don't think it's as easy as we had 1 month of pain and everything is now returned to normal and a big increase. So the question some people are asking is this really a recovery, the start of a new bull market after March 23rd because everything is coming back? Or is it really just a pause and we're in kind of a bear market rally or somewhere in between those things? So we think that recovery was maybe a little bit too optimistic. We think volatility is going to remain elevated. And overall, we think markets will move a little bit sideways. We don't necessarily see them dropping way back down, 30% from where they are, but we think we'll have some ups and downs in the market. We could see some additional corrections. Wouldn't be surprised to see the market dip down a little bit. And there'll be, sort of some movement sideways like this until we see evidence that the virus is being contained and until we understand how this recovery is really going to work in terms of everybody getting back to work around the world and especially in the US and Canada as it impacts our businesses. Now, of course, we're not health experts, but I think it is early to know whether the therapeutic developments and whether the developments on a vaccine are true. We really hope that they are. But if there become some delays from what these optimistic reports are suggesting, you could see some fall in investor sentiment that could impact the market. So generally, we think the market will continue to recover as business gets back to work. But there may be some ups and downs as we go and some spurts of recovery, as we mentioned down here, and that the demand will come back gradually. So I think it's good that things are reopening, but I think consumer confidence and behavior will impact how quickly we really see a return to activity and to levels that we've seen before. So a lot of people talk about what path will this recovery take, and this reminds me of back in the sort of financial crisis. There was a lot of discussion about what alphabet letters are we going to think about in terms of recovery. So there are still some analysts who believe the market will not retest lows at all and that we will see a V-shaped recovery in the second half of this year, meaning that we've seen the worst and we're now going to see a big rise up. But I think there's a lot of uncertainty, so that's not the majority view right now. David Rosenberg, who we follow a little bit to get his more bearish insights, he sort of still talks about sort of an L-shaped or an inverted J-shaped recovery, or a Nike swoosh that some people talk about, and that tends to think on the L-shaped side that we won't see recovery very quickly. We'll drift along the bottom for a while. There was a study recently, Bank of America Merrill Lynch study, that talked about 10% of global managers see a V-shaped recovery, so only a small portion of managers believe that we're completely in the clear. About 75% believe that we're going to see a W or U-shaped recovery. So U-shaped recovery, seeing a little bit more time at the bottom, and then a recovery, W testing some lows a little bit as we go. Even Morgan Stanley, who's one of the more optimistic of the big US banks, they don't think we're going to retest the March 23rd lows, but they don't think it would be surprising to see a 10% correction from where we are today. So consistent with what we said on the previous page, I guess we're more along the W or a little WWW type of letter if we think about the path, that we might see some bouncing around, a little bit of correction in the markets, but we are still moving on an upward trend. So I don't know what that letter is, but that's sort of what we think is going to happen. There are a number of things I think that we all need to keep an eye on as we understand what the pace of this recovery will look like. So one of them is, what's the pace of activity that we're going to see? So as stores are opening, starting now in various provinces and in the US, are people going to be returning, and how quickly will people return? So that's something we need to keep an eye on. How gradual and how slow will this recovery be? In terms of consumer behavior, I think that's a really important thing to keep an eye on. Now, there's certainly a school of thought that feels people will be very careful with their money. Certainly people that have lost their jobs or are concerned about their businesses, that they're going to focus on needs, not wants, and be careful with spending, and they might reduce spending and increase savings levels. So there's a lot of people feeling that may be the impact. On the other hand, there was a speaker I just saw quoted who said that they think there could be the opposite of that too, and we could see a sort of live for today attitude with people, some people having increased spending. And I think relevant to some of the work that you do, I mean, you see a lot of people that are spending a lot of time in their homes right now and identifying projects that need to be done, and maybe that means there will be renewed energy in some building and renovation and that kind of thing. We obviously need to keep an eye on what's going to happen with the virus. So will there be an increased incidence as people open up and start interacting more than they have been in the past stay-home period? And will there be a second wave in the fall or winter? And we really don't know about that, and I don't think it's been priced into the markets. Depending on how long this activity or this gradual recovery takes, we need to then see, will this change the outlook on how temporary job losses are, and what the impact is on small business, really. So with this 80% of people feeling that their jobs are only lost temporarily, will that be the case? Or if things take longer, will some of those jobs become permanently lost? And I think it was interesting, there was a US Board of Commerce report that came out saying that 25% of small businesses had closed, and 40% of small businesses that they had in their survey felt they only had enough working capital for a number of weeks of continued slowdown. So really the length of the recovery may make things more serious in terms of job losses and in terms of other things. Then I think, will this stimulus, so that we've said a couple of times, this government stimulus we think is so important in propping up the economy, and we think hopefully it's providing stimulus, because there are some studies that show that people who are getting the stimulus payments are using them to buy things that they and their family need, so that is putting money back into the economy. So we want to see if that's the case, or will this end up being really temporary life support that just prop things up to a little bit, but we haven't yet kickstarted the economy enough. There have been some worries about negative interest rates. You've probably seen some of those in the press. So that's something that we've seen in Europe, certainly in Germany, and UK is talking a little bit about whether they will move to the potential for negative interest rates. The Fed chair, Jerome Powell, sort of put that worry to rest for now in the US, in that he said their Fed target is really 0 to 25 basis points. So they're not projecting a negative interest rate. And I don't think it's a tool that's a high priority in Bank of Canada terms either. And I think, some people worry that if we do go to negative interest rates, then what's going to happen with the banking system, and do I need to worry about my money in the banks? I don't feel that we do. I think in Canada we're lucky to have strong, stable banking system, and I think there have been a number of stress tests that look at how well the banks will survive, and they show that Canadian banks will be able to weather this storm. So I think we should feel comfortable with that. So in terms of longer term outlook, based on what we said, I think, the recovery might be uneven. We may see some bumps along the road, and it might take some time. If you look at some of the studies for how long, and even what Mnuchin and others said yesterday, it may take us 2 to 3 years to get out of this and get back to normal earnings levels. That's still nowhere near the situation with the 1930s recession. That was a 10-year period. We're not thinking it's going to be that long, but we do think it will take a little bit of time and be uneven. But underneath all of that, we have sound structures in the global economy, and we do have that support from governments and central banks, and I think they have the desire to continue to provide that support. So I think that's going to help continue to support our recovery going forward. And on that basis, we remain optimistic about the long-term prospects for stocks and risk assets in the portfolio from an investment point of view. So we think a lot of people have a long-term view on their portfolio and that there will be a return to positive outlook for these risk assets, and we feel generally optimistic in the long term. There have also been some new opportunities that have been uncovered. Part of it is just pricing has come down on some really great quality stocks that you can buy and hold for the long term. And part of it is that there's been some new opportunities uncovered. You know, if you think about the kinds of things we're doing, sort of home office technologies and online delivery and telecommunications, if they're well funded, and food supplies, and some of those things are providing some opportunities out there, and hopefully your managers are looking for those for you. In terms of what we're advising to investors, or our investors, our clients, we don't think that you should sell off and hide until the markets come back, but we think that it does make sense to raise some cash. And that's not from a timing point of view. That's sort of saying if you need cash in the next 12 to 18 to 24 months, depending on your risk level, maybe we raise it now when we've seen the market come back a little bit and keep it aside. And that just means that we won't have to sell into the markets if we do test lows at some later date, or if there's not a good time in the markets to sell. So we've been sort of looking through our client portfolios, trying to identify that, keeping a little bit of cash on the side, but then saying the rest of the portfolio should really stay invested for the long term in terms with your plan and your comfort levels. If we've got clients that have cash on hand, and we do have some of those, while you could say that this represents a historic buying opportunity, go all in right now, we think because things are going to be bumpy and we know there's investor behavior to be careful with, we think it's good to sort of average into the markets gradually, make a plan to maybe go in once a month for the next 6 months, but also say that you would accelerate that plan if the market pulled back a little bit more. And usually with our clients, we're looking at the best sort of long-term risk-adjusted returns that make sense for your portfolio. We're not trying to hit home runs unless you've got a portion of the portfolio that's really focused on risk and is outside of or over and above what your living needs are. So this slide just talks a little bit about the fact that we've had many reasons over the history of investing for people to get nervous and pull out of the markets. You know, the ones that I think you recognize the most in that first period of 1929 to 1970, Great Depression from 1929 for really 10 years before we saw recovery. In the 1999 to 2011 period, we had the global financial crisis, followed by what some people call the Great Recession. So there have been many times where it felt very nerve-wracking to be in the markets, but I think usually it's best to stay invested with your long-term plan as long as you've got cash outside and you've done other planning and you know you've got the right asset mix. Couple more slides before we go into questions. So I think we're still on time. Longer term implications and what they mean to you. So we've been having a lot of discussions with business owner clients and other clients that we have about what would happen if tax rates rise. So if this growing debt that we're seeing around the world leads to higher tax rates, and nobody knows what that will be. There's nothing been announced yet, but a lot of people feel that something will likely happen. We don't know whether that's going to be an increase in consumption tax or an increase in tax rates, or perhaps I've had a few clients wondering about, will we see an estate tax introduced in Canada? And in the US, certainly people worry about a reduction in the estate tax exemption levels, which would mean more estate tax down there. So we may see something like that happen. We can't speculate on what it will be, but I think it does make a lot of sense to do some planning now. So if you're a business owner and you've been talking to your advisors for a while about some strategies you might consider, like an estate freeze for your family, if that made sense, or other things, it's probably good to have that conversation now. There will be a lot of unknowns, so it's hard to know exactly what you can do, and it's very important to talk to your advisors about your situation, because you need to introduce strategies that make sense for you. But I think looking to planning and making sure you've taken a proactive look at your situation is more important than ever. The second point is really just talking about sort of what I alluded to before, that there are some real changes in behavior and how we conduct business, and those may impact either positively or negatively various industries and investments that we might make. So that idea of home delivery and online services being here to stay may create some opportunities in investment. The fact that a lot of people can work from home, you saw yesterday, I think Twitter said that they're having permanent remote workforce, so they're not going to return to home or to work rather, and that will have implications probably in San Francisco on office management firms and on municipal tax contributions from those offices. So I think, it may be a harder time for office management firms. There could be a shift. Some people have speculated from multifamily to single family homes. I don't know if we'll see that, but you might see that with people wanting to isolate a little bit more. I think travel and tourism are going to take the longest time to come back, and that could lead to higher airfares, but also, will take a while for that industry to return. And then there'll be things like remote work technologies and e-transfers that'll be positive. So I think there are some themes your investment managers can look to in terms of looking at opportunities in your portfolio. As we mentioned, you could see a return to inflation. I don't think that'll happen right away. I think right now, with the zero inflation we have and the low levels of economic activity, that's actually deflationary right now, but we need to keep an eye on that. I think central banks keep an eye on that themselves and are working to make sure we don't see a big return to inflation, but something to keep an eye on. And then my father's always good at reminding me of positive things. So I think, innovation does help us to emerge from crisis, that phrase that necessity is the mother of invention. And I think, as my father put it, we will emerge stronger because challenges make us stronger, and we can look at different ways to carry on. And I think that gives us a little bit of hope as we go forward. So last thing I wanted to touch on before questions was just a couple of key takeaways as we saw them. So first of all, for investors, which we talked about, I think that the starting point is really make sure you've got a policy statement that makes sense for you. So the asset mix that you built wasn't only comfortable when markets were going up without real understanding of your own risk tolerance levels, but it actually ties into what your risk tolerance is now and what your needs are from the portfolio. So make sure you're comfortable with that. Then, as we mentioned, we've been looking at trying to raise or have access to sort of 12 to 18 months worth of cash, just so our clients don't worry that they have to sell into the markets at the wrong time. That time frame that you're looking at could change depending on your risk tolerance. You could say 6 months too, but the idea of having some cash, and that's again not a comment on timing the markets, but just on having cash on hand so that you don't need to sell at the wrong time. And beyond that, stay invested with that long-term plan that you've confirmed makes sense for you. And if you have cash, average into the markets at a planned pace, but possibly accelerating that if markets provide the opportunity. For businesses and for business owners, I think that same idea of having cash, I think it's important, as I'm sure everybody has been doing, to review your balance sheets. We've been talking to managers about how are they assessing the companies in their portfolio, and do they feel that those companies have strong enough balance sheets to survive. But I know even for us running a small business, it's been important to look at our balance sheet and know that we feel comfortable. So you want to make sure you've got cash and working capital that can help you manage through a recovery that might be gradual. Obviously, you want to look at whether you can access government benefits that you're eligible for, and I think you've recently had a talk on that specific comment. And then, as I mentioned before, I think it is a good idea to take pause and look at the tax and financial planning strategies that maybe you didn't have time to look at before, and see what could be put into place. We had one of our longstanding clients who we've been talking to about strategies for a while, and who always felt he wasn't ready and he wasn't going to think about that yet. He called me back recently and said, Krista, nothing like a crisis to have an old guy focus on something that you've been telling him to focus on for a while. So I think it's important to just relook at your situation, see if there's some planning opportunities, and make sure you're making the right choices for you and your family. So that's really what our prepared comments were, which I think takes us to just over the 30 minutes, and we're happy to take some questions now.
Thank you so much, Krista. So we do have a couple questions already coming in.
Okay.
Second time in a week, I have heard about a potential shift from multifamily to single family. Could you expand on this a little in terms of the potential drivers that would support this possible trend?
Yeah, I mean, I really think that's speculation. No one knows for certain. But I think if you think of some countries like Sweden, et cetera, who had a very high percentage of their population who live alone, they felt less exposed to the transmission of germs because there were so many people living at home. I mean, that led them to not do as much self-isolation as everybody else was doing, which I think is still, the jury's out on what the impact of that is. But I think that was the idea, is that some people felt a bit safer being more isolated, and therefore you could see people looking at single family homes. I think it's hard to say because that also has cost impacts, and if people are careful with their money, they might not be thinking that way. But I think that's what the potential trend relates to.
Because of COVID, are there any specific or types of stocks you would recommend to invest in apart from just staying the course?
I think that gets back to some of the trends we're talking about. I mean, I do think there are some really good quality, large cap, safe stocks that have come back down to better prices. So that would get you to look at some of the consumer staple companies. You know, banks are a tricky one because they've had such a hard hit and they may be hit by these low interest rates for a long time. But sort of good quality large cap companies that have gotten cheaper and that you're going to hold for a long time makes sense. But on the other hand, there are some new technologies. So, you know, things like online retailers and delivery companies, are there opportunities there? I mean, some of those stock prices have come up a little bit, but even, you know, we have a private equity and a private equity real estate investment that relates to multi-use industrial space that ends up being very close to airports to allow the facility to aggregate products that are going to be delivered by online retailers. So there's some feeling that that's a positive area in the economy as well. I think, you know, telecommunications and solutions for working from home, that kind of thing has been positive. So I think some of those trends are what we're thinking about, which maybe gives you a little bit of an idea.
Another question, what impact will the US election have on the markets and economy?
That's a very good question. You know, I think I was reading a study yesterday that said that they felt that Trump would not be reelected. I know there's a lot of people on both sides of that, but because of the fact that it's hard to reelect someone in a very difficult economic situation, I think that's why the administration's been really pushing to get people back to work so that that supports his political outlook. But I think there is a chance there could be a change in administration. There was a lot of worry in the economy, I think, or in the markets, I guess, when people thought that Sanders would be the potential candidate on the Democratic side, because that could be a much more socialist type of administration that could result in some negative impacts for the economy. That's not necessarily the case with Biden, I don't think. So I think the short-term impact is that the administration is going to try and do anything they can to improve the economy before the election, because they want to have that not be a negative factor in the election time. So I think you're going to see some continued support and some push to get the economy working. So the short-term level is that. The longer term, if we do switch, you know, you could potentially see a Democratic government introduce things like a higher level of estate tax or other things. So that could have impacts on the economy. But I think you know, that we won't probably see a complete change. I mean, some people feel if the Republicans are not in office, then you're going to see a real negative impact for sure. I don't know that we will see that. I think things will keep moving on, but I think in the short term, there'll be a positive impact. Longer term, we could see higher taxes, and that could impact things too in a slower manner.
What are your thoughts on how the world is going to pay for their debt? Is the only solution global tax increases? I've heard about universal currency devaluation.
Oh, that's interesting. Yeah, I mean, we're assuming that there may be a tax implication there. I mean, ideally, you'd hope that the economy will continue working again, and that's going to help have a natural occurrence in paying down the debt. But I think taxes are the other way. I haven't heard anything about a global currency devaluation. I think that and, negative interest rates and all those things are other tools people are thinking about. But I think a lot of that's going to remain to be seen. I think right now the focus is really on how do we get through this crisis and through the recovery, and then let's start looking at those tools. And to me, the most likely thing is to see some higher taxes.
Where do you see the Canadian dollar over the next several months in light of the US economy?
That's a good question. I didn't really address that. So we had, at the end of 2018, the US dollar was worth about $1.30 Canadian. And then at the height of all of the difficulties, the US dollar was back up to $1.40 and even higher. So there was a real strength in the US dollar that actually probably, if you were looking at your own portfolios, made your US stock returns not look so bad, because in Canadian dollars they had improved. So the US dollar does tend to work as a safe haven currency to some degree and has been stronger. And Canadian currency was negatively impacted also by the energy price issues that happened in March, as well as not being the currency of safe haven as the US is. So I think the US dollar got stronger than it probably should be if you look at purchasing price parity, which means I think that eventually as things resolve themselves and as we work through the recovery, I think the US dollar will weaken a little bit, which means the Canadian dollar will increase a little bit. Not so much on the strength of what's happening in Canada, but on the fact that the US dollar was really propped up a little bit by being a safe haven currency. So we've taken the opportunity in a couple of cases where we're raising cash to convert a little bit of cash from US to Canadian. Again, we don't want to make big trading bets on that, but I think there is a likelihood that the US dollar was very strong and we could see a little bit of a reversal of that as we go forward.
What will be the future of retail post-COVID-19?
Yeah, I mean, that's really interesting. The interesting thing is, which industries will be permanently impacted. And before we get to retail, I think there's things like, movie theaters. Are people going to go back to movie theaters in the same way? And restaurants, if we're going to have half the people in a restaurant because people aren't comfortable being so close together, is that going to be really viable for that industry? So I think there's some big questions which focus on both what's going to happen with the virus and will we find a vaccine and a cure so that we feel very comfortable again, and what will people's consumer behavior be. But retail, I think there will be continued incidents of online retail. I think that's here to stay. There's going to be a lot of that. But I do think, I was speaking with a friend of mine who runs a small business that she's got a very big online operation, but she still has 3 stores, 3 physical locations, and said there's still a very high percentage of sales done in store. So I think the fact that they're now reopening, with very gradual rules, they can't have more than 3 people in a store at the same time. They've got 15 minutes in the store limit, and they've got all sorts of rules. So I think that in-store shopping isn't going to go away, but it will be impacted. And I think, the degree to which it's impacted will depend on how comfortable people feel, how the reopening goes, whether we start to see room for a vaccine, real signs of a vaccine. Hopefully that'll get people back into the stores. But I think in the meantime, stores are really being pushed to have a greater online presence, and I think that's going to continue. And I think that's, that will help them continue to get through things. So I don't think it's gone, retail. I think it's a shift to more online, but we will also see a gradual return to the more traditional. I think there'll be a problem with things like malls. Maybe people won't want to be in malls as much, and that could be an impact also for real estate and other things. But again, all that remains to be seen. I think that if we do find that we have a vaccine next year and people feel very comfortable, then all of this, and how much it will be a change will be lessened. Whereas if we go through a period of time where we still don't have that certainty and there's a second wave, for example, then there will be a deeper impact on various industries.
Do you see that house prices will fall?
That's a lot of people are talking about that, especially in Vancouver and Toronto here in Canada. We haven't actually seen that. You've seen a real slowdown in houses in supply and houses becoming available. So there aren't any houses being shown because you can't get a lot of people coming through to see them. So there's been a supply issue, but that also means when houses have come on the market, they haven't gone down as much in price because there's only so many of them and people want to buy them. So I think, the bigger issues in the markets where housing prices have gone up so much is going to be level of household debt and level of income and whether people have jobs. And if those things go down, then it's going to be harder for people to buy and there could be pressure on the housing market in Canada. But I think in the near term, housing prices will probably stabilize a bit just because people still need to have houses. So it's a combination of sort of maybe near term we won't see as much of an impact once people come back to showing things. But then, there still is that question that Toronto and Vancouver have had very high housing prices for a very long time, and that may not be sustainable.
So if anybody else has any more questions, I'm just going to ask that you put them in the question box. We do have a couple more questions coming in.
Sure.
We are likely already in recession. What sectors are most vulnerable going forward?
Well, I think there's some obvious sectors. I mean, certainly airline travel and tourism in general are very vulnerable sectors. I think it's going to take a long time before everybody gets comfortable getting back on planes. And I do think, that business travel may go down. I have a brother-in-law who traveled sort of 200 days of the year before, and now is finding that he can do a lot of the work he does remotely. There's a time where you still want to meet people, but you probably don't need to travel that many days. And also, again, these are anecdotal, but I think, my parents and their generation are saying, do we need to be traveling as much? And there are certain times of the year where planes are filled with people, with gray hair that are looking to travel to sunny climes, et cetera, and maybe that won't happen as much. So I think that will be hard hit and will take a while to come back. I think retail, again, as we talked about, could take a little bit longer, but hopefully we'll still see people going back into the market and into their stores rather, and doing some online buying. I think hospitality in general, concerts and sports activities and all those things that bring large groups of people together are probably the most vulnerable. And then talking differently about industries, I think what we've been really looking at is across various industries, companies that don't have a lot of reserves, companies that have a lot of debt on their books and that don't have a lot of working capital, they're going to be the ones that are really vulnerable to not being able to wait out this gradual return. So I think that's the other thing to really look for in terms of the companies you're invested in or your own companies, other things, is just making sure you've got a strong balance sheet so you can live through this.
Can you talk about the situation in Alberta?
By the situation in Alberta, I'm thinking that maybe you're talking about the energy markets and how difficult it's been for people in the energy markets. Yeah, I think that's obviously been very hard. I mean, Alberta's always been a sort of boom and bust economy. They've had wonderful times where the energy markets are very high and very low tax rates, so not necessarily built up the reserves that they need in those periods of time. And then there's been really difficult times with energy. I think with energy, and you get different stories when you talk to different analysts, but some people can say in the long term, will there be a reduction in our need for the kind of oil that we extract in Alberta, et cetera, because we're moving to new technologies and because, so is there a secular change in demand for energy is one question long term. But I think a lot of people say that, it's going to be a while before we shift to that kind of movement right away and that there is a demand for oil. So there is continued need. There's also a lot of natural gas being produced there, and that's not as hard hit by that outlook. So I think, they were extremely hard hit through the real pressures the energy market felt in March and earlier. I think, that was a remarkable drop in energy prices, lower than what it should be. I think those prices have already started coming back up, and we'll see that normalize a little bit more. And in the short term, there will be a return to demand and things should be okay, but there is still that question of longer term, will there be a real shift in the economy? So that speaks only to that industry in Alberta. I'm sure there's other activities there, but yeah, it's a bit of a difficult one depending on your outlook for oil and energy. I guess what I'm saying is that it'll come back. It won't be as hard hit as it was in March. It'll come back, and there is some demand that will continue to be there over the next few years, but maybe longer term we have to look at where that economy and industry goes.
Well, that's all the questions we have for now, Krista. So I'm not sure if you have any sort of closing statements.
Comments? Well, just to thank all of you for listening. I hope this provided a sort of at least an aggregation of some information that you might have been seeing elsewhere, and hopefully putting it together in this way is useful for you. I think, the problem with being really precise about where we're going and what we're going to see is that there continues to be a lot of uncertainty out there. So I know nobody's telling you exactly, what's going to happen 100% and what to invest in and how to make things work. It's not as easy as that. But I think hopefully the idea that there, I think we do see optimism. We do see a return to recovery. We see this continued recovery. We just have to be aware that we may not be out of the woods yet. We may see some bouncy moments in the market continued, and we may see a longer recovery coming out of this difficult time, over the next year or so. So to be prepared for that, be patient, have a look at your planning, have a look at your balance sheets for your company and your cash that you need, and sort of shore up a little bit of reserves so that you feel comfortable getting through this. And we will get to the other side. There will be challenges that make us stronger, and we're going to get through this together, to borrow an overused phrase. But I do think there's optimism going forward. So thank you.
Thank you so much again, Kristen. Thank you so much, everyone, for joining us today. As stated before, we are going to be sending out a recording of this session as well as a survey within the next day or so. So please watch out for that. Other than that, I hope you all have a great day and stay safe, everyone.